Hello everyone and welcome back to the channel. Today, we're diving deep into one of the most insidious pitfalls in the markets, overconfidence. If you've ever felt invincible after a string of wins only to watch your profits evaporate, this video is for you. We'll break it down step by step, from what it is to how to beat it. Stick around. I've packed this with actionable insights to protect your edge and your equity. Let's start with the basics. What exactly is overconfidence in trading? Overconfidence is an exaggerated belief in your own abilities, judgments, or predictions about the market. It's not just thinking you're good, it's assuming you're infallible, often leading to risky decisions without proper evidence. Think of it as confidence on steroids, where you overestimate your skill and underestimate the role of luck or market randomness. Now, how does this differ from healthy confidence? Healthy confidence is rooted in evidence. It's built on consistent results from a tested strategy, backed by data and discipline. It's humble, adaptable, and always respects the market's unpredictability. Overconfidence, on the other hand, is ego-driven and illusionary. It ignores data, dismisses risks, and treats trading like a sure thing. Healthy confidence says, "I've prepared well, so I'll execute my plan." Overconfidence says, "I've got this figured out, no need for rules anymore." To understand why overconfidence creeps in, we need to look at the psychological and neurological mechanisms at play. Psychologically, it often stems from ego attachment. Traders tie their self-worth to their P&L, so wins inflate the ego, making losses feel like personal failures. This creates a bias toward protecting that ego by doubling down on risky bets. Neurologically, it's fascinating. When we win, our brain releases dopamine, the feel-good chemical that reinforces behaviors. A series of recent wins floods the system, creating a high that impairs judgment. This is amplified by confirmation bias, where we seek out information that supports our views and ignore contradictions. For example, after a profitable trade, you might cherry-pick news that aligns with your position, blinding you to warning signs. Then there's the illusion of control. Markets are chaotic, influenced by countless variables, but our brains crave order. We attribute wins to skill rather than luck, even when randomness plays a big role. Studies in behavioral finance, like those from Daniel Kahneman, show this as a core cognitive bias. It's why traders feel they can time the market perfectly after a hot streak, despite evidence showing it's nearly impossible long-term. So, what triggers this overconfidence? Let's identify the most common ones. First, winning streaks. A few good trades in a row can make you feel like a market wizard. Suddenly, every setup looks golden. Second, increased position sizing. As confidence builds, you start betting bigger, thinking your edge is unbreakable. This amplifies gains, but sets up for devastating losses. Third, reduced risk perception. Wins dull your sense of danger. The market feels easy, so you downplay volatility or black swan events. Social validation is another big trigger. Sharing wins on forums or social media gets likes and praise, reinforcing the overconfidence loop. Everyone's cheering your genius, but they're not seeing the risks. Finally, market conditions that reward poor discipline. In bull markets or low volatility periods, sloppy trading can still pay off temporarily, masking bad habits until conditions change. These triggers lead to overconfidence manifesting in real trading behaviors that can wreck your account. Let's explore how with some realistic examples. One classic sign is ignoring stop losses. An overconfident trader might think, "This trade can't go against me. I've been right all week." So they widen or remove the stop, turning a small loss into a blow-up. Imagine you're trading tech stocks during a rally. You've nailed 3 winners in a row, so on the 4th, you skip the stop. The stock gaps down on earnings. Boom, 20% drawdown. Deviating from the trading plan is another. Your plan says only 2 trades per day, but overconfidence whispers, "Why limit myself? I'm on fire." You start chasing setups outside your criteria. Overleveraging is a killer. Feeling unbeatable, you crank up the margin, turning a 2% risk into 10%. Example, a Forex trader on a URUSD winning streak leverages 50 to 1 instead of 10 to 1. A surprise rate hike wipes out half their account overnight. Increasing trade frequency often follows. Wins make you hyperactive. You trade more to capitalize on your hot hand, but this leads to overtrading and fatigue. Imagine a day trader who usually takes 5 setups a week, but jumps to 20 after profits, catching losers in the noise. Dismissing risk management rules ties it all together. You skip position sizing calculators or ignore correlation risks, thinking rules are for amateurs. These behaviors aren't just short-term slips. They have profound long-term impacts on your account equity, consistency, and psychology. On equity, overconfidence creates boom-bust cycles. Periods of unchecked wins inflate your balance, but the inevitable drawdown is sharper because risks were amplified. Data from trading platforms shows that overconfident traders often lose 50 to 70% of gains in corrections, eroding capital over time. Consistency suffers too. Trading becomes erratic. Discipline wanes, turning a reliable edge into gambling. You chase highs instead of following process, leading to inconsistent results and frustration. Psychologically, it's draining. The highs of wins are addictive, but crashes breed doubt, anxiety, and even burnout. Many traders quit after a big overconfidence-fueled loss, mistaking it for lack of skill rather than poor mindset. It erodes trust in yourself and your system, making recovery harder. The pattern is clear. Success breeds overconfidence, which leads to recklessness, then sharp drawdowns. It's why even pros like Paul Tudor Jones emphasize humility. Markets humble the arrogant eventually. All right, let's shift to solutions. I'll give you practical, actionable frameworks to prevent and manage overconfidence. These are grounded in real trading environments, so implement them today. First, use objective performance metrics. Track your win rate, risk-reward ratio, and expectancy over at least 100 trades. Review weekly. If your recent streak exceeds your long-term average by 20%, flag it as potential overconfidence. Tools like journaling apps or spreadsheets make this easy. No emotions, just data. Second, implement rule-based risk controls. Hardwire limits into your platform. Max position size at 2% of equity, auto stops, and trade frequency caps. Make them non-negotiable. For example, after 3 wins, enforce a cool-down rule. No new trades for 24 hours. Third, build psychological checkpoints. Before each trade, ask, am I following my plan or chasing a feeling? What's the evidence against this setup? Post-trade, rate your confidence on a 1 to 10 scale. If it's over 8, pause and journal why. Finally, create post-win routines. After a profitable day, step away. Exercise, meditate, or review losses from past journals. This resets dopamine and reinforces humility. One client of mine reads a failure file of past blow-ups after wins, keeps the ego in check. Finally, maintain disciplined execution after streaks with accountability. Join a trading group for peer reviews or hire a coach for objective feedback. Simulate drawdowns and backtesting to practice resilience. Remember, discipline isn't sexy, but it's profitable. In closing, overconfidence isn't a flaw, it's human. But by understanding its roots, spotting triggers, and using these frameworks, you can trade with healthy confidence that lasts. If this resonated, hit like, subscribe, and drop a comment. What's your biggest overconfidence story? Let's learn together. Thanks for watching. Stay disciplined, and I'll see you in the next one.